Hey, welcome to this week's episode of Ask the Instructor. I'm John Chrisman. The show is brought to you by the Tampa School of Real Estate. If you're thinking about starting or enhancing your career in real estate, give us a call. The phone number is 813-928-0106. Again, that's 813-928-0106. You can also visit us online at tampaschoolofrealestate.com. That's tampaschoolofrealestate.com. Make sure you check out the Success Center. That's where you're able to find all of these videos from all of our past episodes. That's tampaschoolofrealestate.com/success. Today we're talking about some fees. Different types of fees that you're going to see possibly when you or maybe one of your clients are trying to obtain a mortgage. There's two main ones that we're going to talk about today, although there could be others. Discount points and origination fees. So discount points and origination fees, these are two usually major fees that you're going to see when you're taking out some sort of mortgage. So in addition to the down payment money, you typically have these additional fees that you're having to pay. Now, there's a specific purpose for each one of these. It's not just to make the lender more money, although they can be used to do that, but the primary purpose, the reason why these types of fees exist. Let's start with the loan origination fee. This is typically used as kind of like a commission. So usually when you're taking out some sort of loan, or your client's taking out a loan, we have the borrower, we have the mortgage loan originator, the MLO, and the mortgage broker. But they're just the middleman between the borrower and the lender. And the lender is who actually has all the money. Lender has the money, borrower wants the money. The broker and the mortgage loan originator, this is our middleman. Just like a real estate broker is the middleman between a buyer and a seller. In this case here, what's being bought and sold is money. Lender selling money, the borrower is buying money. That's essentially what's happening. So that's where these broker and mortgage loan originators come in. So this origination fee, this is a creation fee, and typically this is used to compensate this middleman entity that's in here for creation of this loan. It could be just a fee that the lender is charging for creating the loan. That could be it as well, but typically that's where you see this play out. Now, these mortgage loan originators we're talking about in here, I definitely recommend teaming up with. Notice I don't say partnering up with. You don't want to use that term partner. That creates all kinds of legal implications that you don't want. So you want to team up with at least one lender, if not a couple of lenders, so you have somebody you can direct your clients to when they're looking for financing. Because this could be a complicated process. And at the very least, even if you don't have any clients yet, it's good to kind of talk to a lender, start to get to know the lender, know what they can offer your clients, know what types of loan programs they have. Know what it's going to take to get approved for a loan. Because when you can start getting these pre-approvals done ahead of time, that's going to save you a lot of time on the back end when you're working with clients. You might find a client is nowhere near being able to be approved for the type of house that they're looking at, for the value of house that they're looking at. So working with a lender will help you out a lot with that, and they can help kind of clarify some of this stuff for you as well, so I definitely recommend that. So we talked about the origination fee. This is for origination or creation of the loan. And these words really kind of clue us in on what it is that we're talking about. Here we're talking about origination or creation of the loan. Up here we have discount points. Discount points, you might have heard this word point. They might be expressed just as a point. If we're talking about points, it's typically discount points are the types of points that we're talking about. So what does this discount mean? What are we discounting? Because obviously we're paying money out of pocket, so most people won't think when you have to pay extra money that it's a discount. But it really is. The intention of this discount point is to lower your interest rates. So the whole purpose of these discount points is to discount your interest rate. And this usually occurs by 1/8%. So usually for every point that you purchase, every discount point that you're having to pay, that's going to decrease, in theory, your interest rate by 1/8%. Now we're going to be working with the numbers today to try to make sense out of all this here. Essentially what you're doing with these discount points is you're prepaying the interest up front. You're paying for the interest on the front end, so you pay less in interest on the back end. For every point that you pay, that's decreasing the lender's yield, how much interest they're getting, by about 1/8%. And there's a couple different ways to look at this, but when you're considering purchasing a home yourself and using financing, or if you're advising a client that's considering using financing for this, maybe they're comparing multiple offers from multiple mortgage loan originators or multiple lenders. Or maybe the mortgage loan originator doesn't. The mortgage loan originator should kind of know about this and be able to explain it, but maybe they're just talking over your client's head. So this is where you're an invaluable service to your clients when you could break this down into simple terms that they can understand. And that's the whole kind of key thing we're trying to do today, is break this down into simple terms, make it easy, but we also want to have a break-even point. So if we had no discount points with just all interest, if that was an option, if one option was no discount points and just all interest, meaning we're paying all of our financing charges on the back end basically, typically you're going to be looking at higher interest than if you're paying discount points. But again, we'll work with the numbers for this in just a second. But let's get the theory of this down here. If we have all this money that we're paying on the back end but nothing on the front end, there's no real, nothing really that would say, hey, look, we need to make sense out of all this. But if we're paying some of this on the front, if we're paying some of this interest up front, normally if we would rather, if this was an even trade-off, which it's not always an even trade-off, that's why you want to know how to work with these numbers, because it's not always an even trade-off for discount points to a lower interest rate. We'll work through some scenarios with that. But if you're paying this money up front, maybe that doesn't make sense if you don't plan on living in the property for a long time. If maybe you're only planning on living in the property for a year, maybe 2 years, that might not make sense. So what we want to try to do here is use these numbers, figure out how much it is we're paying out of pocket, and then try to determine what that's going to look like and whether or not this makes sense, or which loan option makes sense. We're going to have a couple different loan options that we're working off of here as well to kind of go through and really make sense out of all this stuff here. So one other thing on here, we talked about how this affects interest rate for each point. 1 point is equivalent to about 1/8% of interest. The other thing we need to discuss here is how much this cost your borrower. How much 1 point cost your borrower. And in this case, 1 point typically equals 1% of the loan. Very important you remember that this is of the loan. So 1 discount point equivalent to 1% of the loan. So this is going to be how this affects the cost, how much money they're having to pay out of pocket. This one is going to be how it affects the yield / the interest. It kind of depends on how it is that we look at this here. If you're kind of using this to study for your exam, yield is probably going to be how they ask about this on the exam. But in the real world, it's also important to understand how this affects your client's interest. Because typically, these calculations, you're usually not doing them for the lender. If you're getting involved in this as a real estate practitioner, as a broker, as a sales associate, and your client's saying, hey, help me make sense of this mortgage loan. You know, I was asking the mortgage loan originator about it, but they were just using so many big words, I'm not even sure if they even know what this means. So can you break this down and make it simple for me? And that's what we're going to be doing today. We're going to take a quick commercial break, but when we come back, we're going to work in some numbers, practice with some scenarios, and try to practice presenting this to clients in simple terms that they're going to be able to understand. So stick with us. I'm John Chrismo. You're watching Ask the Instructor. When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment. Need help preparing for your exam? We've got you covered. Join us for a structured weekend review class where we'll cover the topics you need to know to pass your class and state exams. Class sizes are limited, so reserve your seat now by calling 813-928-0106 or registering online at tampaschoolofrealestate.com. Have you been thinking about starting a real estate career, but are struggling to find the time to go back to school? Allow us to introduce our revolutionary online course platform. At the Tampa School of Real Estate, we have used our years of education experience and student feedback to bring you the finest and best online course. Visit tampaschoolofrealestate.com. That's tampaschoolofrealestate.com, or call us at 813-928-0106. That's 813-928-0106 to learn more and register for our online course today. After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career. Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Kursmo, and this show is brought to you by the Tampa School of Real Estate. Every Wednesday at 12 noon Eastern Time, we come to you to help you understand these more technical, knowledge-based topics that you really need to know to not only pass your exam, but understand this real estate industry. When you're purchasing a property or any of your clients are purchasing a property, financing is almost always used. Even when investors are purchasing properties, they almost always use financing. Yes, cash sales do exist, but it's a very small percentage out of the real estate market. This financing machine is really what keeps our real estate market turning. So understanding this is of the utmost importance, because this is a complicated industry. I don't know if you've noticed this, but the banks don't make this easy. Lenders, financiers, the people charging you this money, they make it sound complicated, so you just pay the money. Like, you know what, I don't understand it. You seem to know what you're talking about. This seems like it's legitimate here. Just take my money. And too many people write this all off just like that. But so what we're doing today is trying to make sense of that, because, like I said, typically a mortgage loan originator would be the one that should be answering these questions. But, you know, this is their specialty. Their job is real estate financing. So they might have a tendency to maybe talk about this in terms that your client doesn't understand. Or maybe your client doesn't know the right questions to ask. So this is where you, as a real estate professional advisor, whether you're a sales associate or a broker, to advise your client here if they ask you a question. Or maybe you want to just kind of understand what you're looking at here. Part of the contract when you're buying properties is specifying information about the financing in there. So this is really crucial for you to understand, and it's a big part of your exam if you're watching these videos to try to study for your state exam. The stuff on financing makes up about 13% of your exam, so it's a really big chunk of this. It's really important information that you need to know. So, like I said, we're going to work through some scenarios here so we could start to get an understanding of this. We're going to start off with some basic stuff. We're going to build upon this to make it a little bit more complicated and maybe have two alternatives that we can compare to each other. So if our clients are saying, hey, look, I've got these two different loan offers here, which one do you think is better for me? Because they might be better for one person, but the other option, loan A, might be good for one person, but loan B might be better for a different type of person based on kind of the time value of this money. So let's start off with some of the basics here. So discount points. And actually, before we even talk about discount points, let's just talk about the loan origination fees. The loan origination fees are even easier than discount points, so let's get them out of the way. So our loan origination fees are going to be 1% for each percent, so it's just 1% to 1%. There's no crazy conversions we have to do with origination fees. These are typically given to you in terms of a percent, and that's a percentage of the loan amount. So let's say that we have a loan origination fee that is 3%. Again, we'll keep it easy. We'll do a $100,000 property. So $100,000 property. But now, is the loan origination fee based on the value of the property? Absolutely not. The loan origination fee is based on the loan amount. So let's say our loan is 80% LTV, which stands for loan to value. So we have 80% loan to value. That means $80,000 of this price of the property, 80%, $80,000 is going to be our loan amount. And you see we're really understanding what these terms all mean and what these are all based off of. It's not just necessarily memorizing a formula, because a lot of people with the formulas get hung up on you multiply this number by this number. But it's really what these numbers represent. It's the loan amount times 3%. So what we need to do basically is take 3% of 80,000. So we punch in our 80,000, multiply that by 3%. We end up with $2,400. So $2,400. That would be our loan origination fee. And we could also solve this backwards. How can we solve this backwards? Well, if we want to figure out, let's say the loan origination fee is $2,400, and we want to figure out what that is in terms of a percentage, all we're going to do is take 2,400 divided by 80,000, and we're going to end up getting 0.03. And you put that in your calculator, you just move 2 places to the right, and that gives you 3%. So if you want to find the origination fee when you have the percentage and the loan amount, you're just taking the loan, multiplying it by 3%, you'll end up with $2,400. If you have the charge of the loan origination fee and you have the loan amount and you have the percentage and you want to figure out the actual loan amount, what you're going to do is 2,400 divided by 80,000, you're going to get 3%. And there's even another way we could work with this. Let's say we know that the loan origination fee is $2,400 and the percentage of that is 3%. Now this is a pretty uncommon one that you probably won't ever come across. But essentially all you're going to be doing with this one, because I mean typically you know what the loan amount is, you usually don't need to find that, but let's just say, because on your exam this could be a potential question, we have a loan amount of 80,000, or we don't know what the loan amount is, we know it's going to come out to 80,000 because we're using these same numbers here. All we're going to do is 2,400 divided by 0.03. So 2,400 divided by 0.03 is going to give us back our $80,000. So really, once you have these three pieces worked out, they're always going to equal out to each other. It's always going to be the same. On a $80,000 loan, 3% loan origination fee is $2,400. If we have a $2,400 loan origination fee on an $80,000 loan, that's 3%. It's a 3% loan origination fee. If we have $2,400 in origination fees, and that's a 3% origination fee, we divide that by that, and we'll get an $80,000 loan. So that's our loan origination fee. Now this one, it's not really too complex. Loan origination fee is actually quite easy and straightforward, as you can see here. Like I said, this is kind of like the commission the lender charges. Now let's talk about discount points. Because discount points are tricky. There's a lot more to discount points than it is the loan origination fee. That one, we covered all of that in probably not even 5 minutes, going through everything you need to know about loan origination fees. The discount point, let's start off with, because again, we want to start off with the basics of this here. So let's start off with how much the cost of a discount point would be. So if we're looking for the cost, how much money has to be paid out of pocket by a borrower for discount points, essentially what we're going to have to do is know that 1 point is equal to 1%. And 1% of what? Again, of the loan. All of these loan calculations are all based off of the loan amount. We're not charging this off the value, because maybe you're only taking out a $10,000 loan and it's a $1 million property. It wouldn't be fair for them to charge you 1% of the $1 million property. That'd be the entire loan amount right there. You're only taking out a 1% loan in that case. So these are all based off of the loan amount, not the value of the property. So let's say we're charging 2 points. And 2 points, 1 point is 1%, 2 points is 2%. That doesn't change. It's not exponential. You're going to have 2 points is equal to 2%. 20 points is equal to 20%. So 2 points, 2% of the loan. Now, of course, we do need to know what the loan is. let's say we've got a $100,000 loan. 2% of that is going to give us $2,000. So the dollar cost of these points would be $2,000. So if we had 2 points on a $100,000 loan, we'd have to pay $2,000 up front. This is essentially, like I said, like prepaying your interest. Now, before we get into how this affects interest, or how it could potentially or should affect interest, how it definitely affects the lender's yield, what we need to talk about now is, let's say we have, maybe we don't know how many points it is, but we know it's $2,000 for the fee. And we want to figure out of this $2,000 points, how many points it is on a $100,000 loan. All we're going to do here, it's just like the loan origination fee calculations. We're going to take $2,000, divide it by 100,000, and we're going to end up getting 0.02, which is 2%. Which that gets a little bit tricky here when you see that, because you expect to get a whole number, for instance. So if we have $2,000 in points on a $100,000 loan, we take the dollar amount of the points divided by the dollar amount of the loan, so 2,000 divided by 100,000, and you're going to get 0.02 as your answer. What you have to remember is points are just a percentage. So 0.02, when we convert that to a percentage, it's 2%. 2% is 2 points. So don't get yourself too confused and caught up there. Don't think you did something wrong because you're ending up with a decimal. You're always going to end up with a decimal. It's going to be a small decimal at that, because you remember you're getting an answer in terms of a percentage. And when you put in your calculator, it's going to come up as a decimal there. So let's take this same situation. The same situation where we have 2 points on a $100,000 loan. So let's keep that all written down right up here. We have 2 points, $100,000 loan. But now the question is, how much do we have to pay out of pocket? The question is, how does this affect interest? Whether this is increasing the lender's yield. So there's 2 ways we could look at this. We could look at it from the lender's perspective, where we're saying, okay, how much money is the lender making by charging these discount points up front, as opposed to just charging us interest on the back end? How much more money are they making? That's one way to look at it, but your client is probably going to be more concerned with, hey, how does this affect my interest rate? What would my interest rate be in a perfect world where this is all equal to one another? But if we didn't pay any discount points, how much higher would my interest rate be? So what we need is the interest rate. So let's say we have a 5% interest rate. We have a 5% interest rate, 2 points, and a $100,000 loan. And basically what we're going to try to figure out here is how this affected, because we're paying these 2 points, how much our interest would be if we didn't have these 2 points. So again, in a perfect world, because your lender won't always make it even scenarios like this, and that's why we're going to do some practice with some different scenarios so we can go through and basically figure out which of the 2 is the better option. So, like I said earlier, let's move this 5% up here. Like I said earlier, 1 point is equal to 1/8 of a percent of APR. APR standing for annual percentage rate. That's usually how they're going to specify your interest rate, through APR. So each one of these points is 1/8. So what is 2 points? It's 2/8. Now, it's actually an even easier trick than that. Really, all you need to do is just take the number of points, put it over 8. There you go. Now you have this in terms of an APR. You take the number of points, you put it over 8, divide it by 8. So basically, we've got 2/8 of a percent of interest. Now, some of you out there, maybe if you're really good at math and you're really good at fractions, you're probably freaking out at me saying, hey, that's an improper fraction. You got to simplify. Simplify that down. Yeah, we could simplify. So we could simplify this. If you're good with simplifying, you'll know you could just divide both of them by 2 and you'll get 1/4. Or if you don't like simplifying, you like something, or it's there's a machine telling you what the answer is, what you could do. Anytime you need to turn a fraction into a decimal, because ultimately that's probably what we want to find this as a decimal. The fractions are nice if you're good at fractions and you like fractions and you really understand fractions, but Most people don't like fractions. I'm not a fan of fractions. I have to work with them all the time. So all you need to do is take the top number divided by the bottom number, 2 divided by 8. And I will show you this here just so you know. I'm not trying to pull a fast one on you. So all you do, 2, that's a division sign right there, that little sign in between that's separating our top number from our bottom number. Our numerator from our denominator if we're going to use our fancy fraction terms. So 2 divided by 8, and we get 0.25. So I'm not lying to you. It's 0.25. Probably like, John, okay, I trust you that you did your math right. You seem to know your stuff. Thank you. So 0.25. This is 0.25% of an APR. The key thing to remember here is we don't need to move this around at all. This is already in terms of a percentage. Now, unlike what we were figuring out before, we had to turn this number into a percent. We turn this into a percent of how it affects the APR by putting it over 8. So what this is going to end up being, when we add together our 5% interest, and really it's just as simple as adding 5% to that, 5.00%, and then together we get 5 1/4 or 5.25%. Now there's a couple of things we could call this number. We could call this number the total yield to the lender. Total yield to the lender, because this is how much the lender is going to get in yield, because they're getting 5% on the back end off of just the interest, and they're getting 1/4% up front off of the points that they're charging, off of these discount points. So this could be called the lender's yield. And if you're taking the exam and trying to study for the exam, that's probably going to be the word you see when they're asking what this number is. They're going to probably ask for the lender's total yield. Yield is just like return on investment. This would be the lender's return that they're getting on their investment, the yield. So by you paying that $2,000 up front as a borrower, that's increasing the lender's yield that extra 1/4%. So in a perfect world, it's not a perfect world, so this isn't always the case, and that's why we're going to practice with some alternate scenarios so you can kind of pick which one is correct. But in a perfect world, 5% plus 2 points is exactly equivalent to 5.25%. So that's basically what we're trying to figure out here. That let's say we have 2 different loan options. We have loan A, loan offer A, and loan offer B. So loan offer A says, hey, we had to pay 2 points up front, which if this is a $100,000 loan, would be $2,000 we're paying up front. And then we pay 5% on the back end. And we're going to have lower monthly payments maybe, or less interest that we're paying it off quicker, or however it is that this is structured. There's other factors that will play into this as well that you need to keep in mind. But as far as this just relates that, hey, we're paying $2,000 up front. That's what that 2 points is equivalent to. But hey, if we pay this $2,000 up front, we don't have to pay a higher interest rate. Or loan option B, and these are really, aside from the present value of the money, which we're going to get into in a second, aside from saying, hey, whether or not I want to take the money out right now and pay this money out right now, if that's not a factor, because sometimes, and this is why it'll be different for different clients, if they don't have this $2,000 out of pocket and they have an option, even if this is a higher percentage, where maybe it's 5.5% interest, if they don't have the extra $2,000 to pay up front so they can get that 5% interest rate, they've pretty much got to go with option B with no money out of pocket for the discount points. But if they do have the money, but they're saying, hey, should I pay this? I have the $2,000, but should I pay it just because I have it? If they're giving me these 2 options here, or even if they don't give you 2 options, maybe you ask for an option, hey, look, I don't want to pay any discount points. What kind of interest rate would you offer me? And that's where you might have to do some of these calculations to figure out, okay, what the cost would be. If this were the case, 5.25%, that's just the difference of an extra 2 points, which would be $2,000. So this would be a better option if we don't want to pay any money down, but ultimately, in the long run, we're going to pay the same amount across the 2 of these. Whether it's we're paying the $2,000 up front, or we're just paying it all on the back end. But now another factor that plays into this here is how long our buyer plans to live in the property for. Because if they're going to hit it and quit it, they're going to move in and move out, they're going to live there for a year and then move on to another place, This one doesn't probably make a whole lot of sense because they're prepaying this money they normally wouldn't have to pay. They probably wouldn't even have paid this equivalent amount to it. We're going to have to get into a little bit of amortization to kind of understand that, but we're just going deeper and deeper down the rabbit hole. You're watching Ask the Instructor. Don't go anywhere. When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment. Need help preparing for your exam? We've got you covered. Join us for a structured weekend review class where we'll cover the topics you need to know to pass your class and state exams. Class sizes are limited, so reserve your seat now by calling 813-928-0106 or registering online at tampaschoolofrealestate.com. Have you been thinking about starting a real estate career but are struggling to find the time to go back to school? Allow us to introduce our revolutionary online course platform. At the Tampa School of Real Estate, we have used our years of education experience and student feedback to bring you the finest and best online course. Visit tampaschoolofrealestate.com. That's tampaschoolofrealestate.com, or call us at 813-928-0106. That's 813-928-0106 to learn more and register for our online course today. After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career. Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrisman. The show is brought to you by the Tampa School of Real Estate. If you're thinking about starting or enhancing your real estate career, first and foremost, give us a call at 813-928-0106. But also make sure you tune in every Wednesday at 12 noon Eastern Time, where we decipher the cryptic hieroglyphics that is real estate. And what we're talking about today is discount points. Discount points and loan origination fees. Mostly discount points, though, because we already went through loan origination fees. We blew through those. Those ones aren't quite as complicated as discount points can be. Now, we already went through and basically done all the math to figure out what a dollar cost of a discount may be, and then what the yield to the lender may be for discount points. Dollar cost for 2 points on a $100,000 loan, that's 2% of a $100,000 loan, which is $2,000. The yield to the lender, each point is 1/8%, so we just put the 2 over 8, we divide that out, we get 0.25. So 2 points is equivalent to a 0.25% yield to the lender. But now, what does this all mean to your client? Because that's where you're going to need to use this in the real world, where your client says, hey, look, I'm super confused. You've been really helped through this at all. Do you know anything about this financing stuff? Or should I go try to look it up online? And they're going to come and find me telling you how to solve these discount points. And they're going to tell you, hey, look, you should go watch this John Grismo guy, learn how to solve discount points. So you can go ahead and tell people about that. You should know how to do this. That's not good for your referral business. So your knowledge is going to help you earn this real estate commission. Notice I don't say make real estate commission, it's earn real estate commission, because you got to serve your clients if you expect to earn real estate commission, and if you want to earn their future business, and if you want to earn their referral business, which ultimately means earning money. So the knowledge definitely is helpful. Don't just write this stuff off that it's stuff you just need to know for your exam. Yes, you'll definitely need to know this for the exam, but what we're going to talk about now, these alternative scenarios, is we're going to help out for understanding, hey, which loan option should I pick? Loan A or loan B? So we're going to go through, have two different loans we could look at, And we'll start off with just a few minor things that are going to be different with it. We'll start with a few minor things that may be different, and we'll kind of incorporate some more differences in here just to make sure you kind of can get this and you can kind of at least work through some of this stuff here. And this is really easy calculations too. There's so many calculators available on Google and whatnot, but when you kind of go on a Google calculator, something like that, and your client sees that that's what you're doing, they're like, oh, this person isn't the magic man or the magic woman I thought they were. They're just using Google. I use Google. I've got Google too. That's not a special real estate tool. So, enough of the funny stuff. Let's get back to the discount points here. Let's say we have this loan. Let's use some different numbers here. Let's try to use some realistic numbers. We have 3.75% interest. So 3.5% interest, and let's say that we're going to have to pay, let's do something ridiculous. Let's say 7 points. 7 points. And finally, we just need the loan amount for this as well. Let's say that, and again, we'll kind of work through some of this stuff here so you can see I could really decipher all this information. Let's say we're buying a property for $250,000. So we have a $250,000 price, and really this is going to be the same for both of these sides here. We're not going to do different properties. We're just going to do the same property. $250,000 of price, and let's say it's a 10% or 90% loan to value. So 10% down, 90% loan to value. That might be why we have these higher points here, because we're doing a low down payment loan option. It's a little bit riskier for the lender here with these low down payment types of options. The lower we have as a down payment, meaning the higher our loan to value ratio goes, means that you have less skin in the game. If we have 100% loan to value, you can walk away from your property and say, yeah, go ahead, foreclose on me, mess up my credit, but you're not getting any money out of me. And you could say, I don't care about that house, I don't have any money in it anyways. It's a crappy house anyways, didn't even want it. But the more you decrease this loan to value, the more down payment that you put in. That's instant equity, so that's money tied up in the property. And yes, on a $250,000 property, that means that a 10% down payment would be $25,000. So let's get these numbers down here, because this is all the stuff we want to kind of work out, get on paper here. So $25,000 down. And that would mean that our remaining $225,000 is going to be our loan amount. So all of this stuff is going to be based off of that $225,000. Remember, we're basing this off the loan amount. We're not basing it off of the price. It's always based on the loan amount. All these numbers revolve around the loan. The sun in this little real estate solar system, the center of the universe, is the loan as it relates to discount points, loan origination fees, and everything like that. So we have our $250,000 property. We're doing a 90% loan-to-value loan, $25,000 down, $225,000 loan amount. Our first loan option for this $225,000 loan, let's just circle that so we know that's the important number we need to deal with here, is 3.75% interest and 7 discount points. Our second loan option is going to be 4.45% interest and 0 points. No discount points. And now it could get even more complicated than this in the real world. Yes, believe it or not, it can get more complicated. It usually does get more complicated than this here. But this is really the key of kind of understanding which one of these is the better option. Is it the lower interest rate with the higher points, or the higher interest rate with no points, with no money out of pocket? And sometimes this is a real simple, easy calculation, because 7 points, 7%, let's figure out the dollar cost of this point. So in addition to the $25,000 down your client would be having to pay, in addition to that $25,000 they're already having to pay out of pocket to go towards the equity of the property, in addition to that, and in addition to their closing cost or whatever other fees they're going to have to pay, they also have these 7 points on this loan. This might eliminate this as an option altogether. So this might be a real quick and easy way to say, hey, you know what? Discount points aren't an option because we only got about $27,000, $28,000, whatever it may be to close with, and we can't really fit that into our budget. So in order to figure this out, we're just going to take 7% of our $250,000 loan amount, so $225,000 loan times 7%, 7 discount points, that's an extra Ready? This is a big number here. A really big number in relation to how much we're putting down already. $15,750. So yes, that lower interest rate is fantastic. It's a much lower interest rate than option B. But what this means is our borrower might have to pay extra $15,750 in discount points in addition to the $25,000. So just for this, not even factoring in closing costs or any additional fees they may have, but just for their down payment and the discount points between the two of these, $25,000 and $15,750, we're looking at $40,750 out of pocket. Plus closing costs, which are probably going to be another couple thousand, unless maybe you have an agreement to negotiate this with the seller to maybe get them pay your closing costs, whatever it may be. But you're looking at $40,750 with loan option A. So that's how much money has to come out of pocket. That's one way to look at this. Another way we could kind of look at this is, okay, let's say we have the $15,750. We can put this $40,750 down. That's not the big issue. And when people have this extra money laying around, or like, oh, should I put it in there, should I not? They're usually concerned with, hey, is there a better use for this money? Should I just tie it up in the house? And really, they should be asking that question for this, because that's going to be important for how long you have to live in the property to really realize the benefits of these discount points, which we're going to be talking about in a second. So with this option over here, 4.45%, now the question is, okay, which one of these is going to be better? Let's say we can't afford this, and ultimately, if this is an even exchange between the two of these, if these are equivalent, and what we need to do to find if they're equivalent is turn this into an APR, turn the 7 points into an APR, which we're going to do in just a second. If we could do that, and this equals out to 4.45%, and we plan on living in the property until the mortgage is paid off, either option is viable, and you're not really saving money one way or another unless you figure the opportunity cost of maybe getting a higher return on investment if you invest somewhere, whatever it is that we want to factor in, but we won't even go that far down the rabbit hole. So what we have here is 7 points. Now remember, when you want to turn points into an APR, we're dividing by 8. We're taking our 7 points, so basically we have 7/8 of a percent of interest. So what we need to do is just 7 divided by 8. And we're going to get 0.875. So our yield, as it relates to the discount points, is 0.875. Those 7 points that we're paying up front would be the equivalent of us paying 0.875% of APR on the back end. Now let's see if this makes sense with our 0-point option over here. We have this 4.45% option, and we want to figure, okay, if we pay these points up front, which one of these is a better deal? So we could subtract out our 0.875, so we'll just do 4.5, and you don't have to worry about transferring the decimals and everything. We want our answer as a percentage anyway, so you just leave it with the decimals we have here. So 4.45, subtract out our 0.875, and this is going to be 3.575. So we can see that this number is significantly lower. And what that means, this might make a little bit more sense now when I add this over here on this side, the 3.75% plus what our 7 points are in terms of yield, which is going to be, again, 0.875. So we have 3.75 plus 0.875. Notice how I added over here and subtracted over here. That's going to be 4.625. All right, so we've got really our actualities that we're working with here. So if this is a perfect world and this wasn't even exchange, if we did pay the 7 points here, that should decrease this 4.45% down to 3.75. 3.575%. It does not decrease it down to 3.575%. It's only decreasing our interest rate to 3.75%. So seeing this here and seeing that basically, hey, this is a lower number here, we're actually paying more money on this side because when we add in our discount points, the 3.75%, that's on our back end, that's our back end charge. We add in what this front end charge equates to on a back end of the yield here, what this upfront, what was it, $15,750 is equal to, which is 0.875%, and we get 4.625%. So in this case, this one over here, no discount points, we're looking at 4.45%. And that's the total yield because we don't have any discount points in it. Total yield is real easy when you don't have discount points or other fees to complicate it with. It's just 4.45%. Really, you don't even have to subtract this all out if you've added this over here, because you could easily see that this number, 4.625, is higher than the 4.45% of interest. So these are our two total yields, 4.625 and 4.45. Which one would you rather take? I mean, this one, it definitely makes sense to take the lower interest rate, and you don't have to pay any points up front. Now, in the real world, this might be flipped around. I was just kind of making up these numbers as we go, so we'll do some more of it here where this might not always be the case. Because typically, paying the points up front would probably be the better option because the lender might want these points up front, but don't always trust your assumptions. That's what this is a lesson here in and of itself. Don't trust your assumptions. Do the math. Find out exactly how this all kind of correlates and corresponds with each other here so you know, and you can tell your client with confidence, hey, look, we could do loan option B, and we should definitely do loan option B because loan option A, not only do you have to pay money out of pocket, but overall, you're paying more. So this might be a little bit of deception, and maybe we're not calling it deception on the lender's part, but maybe there's somebody that's deceiving somebody here because you would think, oh, you're paying discount points? That must be discounting your interest. That must be discounting. That's good. It's good to pay this $15,750 up front. That way you don't have to pay it on the back end. Not only, number one, would I say, hey, let them wait for their money. I'll pay the higher interest rate if they have to wait for their money. But not even factoring in that time value of the money here. This is just basically saying, hey, maybe they won't do the math. Maybe they won't figure out that this $15,750 is only 0.875% in terms of interest and will really end up getting 4.625%. So they're able to squeeze out an extra 0.2% about. An extra 2.2%, which over 30 years of APR, that's a huge amount of money, some extra money they just cha-ching cashed in on because you didn't do the math. So again, don't trust your assumptions on this. Just because you're paying discount points doesn't mean it's a better deal for you. Not only do you have to pay the money out of pocket, but you're paying more. You would think, oh, I'm paying it up front, I'm paying it early, that's going to save me money in the long run. No, in this case here, option A is terrible. Never pick option A in this case. Never, never, never option A. You only want option B because option B is the 4.45%. And if you're able to pay perfect discount points where it decrease the interest rate, it would make it so you'd only be paying 3.575% if you paid that $15,000, not 3.75%. So that's just one scenario. We're going to do another scenario here, and it's going to be a little bit flip-flopped, where it will be a better case to pay the discount points up front, but now we have to ask the question of, hey, should we pay these discount points up front if we're only living in the property for X amount of years? So stick with us. I'm John Chrismo. You're watching Ask the Instructor. Don't go anywhere.
When you look back on your real estate career, you'll remember the moment you decided to begin this journey. The moment when you finally decided it was time for change. The moment when you decided it was time to take charge. The moment that changed the direction of your life forever. Now is that moment. Need help preparing for your exam? We've got you covered. Join us for a structured weekend review class where we'll cover the topics you need to know to pass your class and state exams. Class sizes are limited, so reserve your seat now by calling 813-928-0106 or registering online at tampaschoolofrealestate.com. Have you been thinking about starting a real estate career but are struggling to find the time to go back to school? allow us to introduce our revolutionary online course platform. At the Tampa School of Real Estate, we have used our years of education experience and student feedback to bring you the finest and best online course. Visit tampaschoolofrealestate.com. That's tampaschoolofrealestate.com, or call us at 813-928-0106. That's 813-928-0106 to learn more and register for our online course today. After the show, be sure to visit tampaschoolofrealestate.com. Again, that's tampaschoolofrealestate.com, where you'll find all the information you need to start your career in real estate. Also, be sure to check out our Success Center, where you'll find helpful tips for building a successful real estate career.
Hey, if you liked the show today, be sure to hit like and subscribe and post your comments. Thanks so much for watching. Hey, welcome back to this week's episode of Ask the Instructor. This week we're talking about discount points, and every Wednesday at 12 noon Eastern Time we come to you to help you understand the more technical part of the real estate industry. Not just information you need to know to pass the exam, but now we're talking about how to properly advise your clients on which type of loan they should take. And I've got a different scenario up here for you, and this scenario is going to work out a little bit better. So these two loan options, loan option A and loan option B, these are going to be exactly the same in a perfect world in a long run. If you're going to live out the property for the entire 30 years or entire 15-year term, whatever the entire mortgage term may be, these would both end up being the same out-of-pocket cost. So this is just basically now the difference of paying the money up front versus paying the money on the back end. And the way this works out here, again, 6 divided by 8, that's going to be 0.75. 3.75 plus 0.75 is 4.5. So these are two completely same money out of pocket in the long run loan options. But now the question is, should I pay this up front? Should I pay this extra? Again, let's go off of our $225,000 loan amount. So on $225,000, 6 points, is going to end up being $13,500. $13,500 that we're paying. So $13,500. Now, what we need to kind of ask ourselves here to see if this makes sense for how long we're going to have to factor in living in the property, we're going to do a bit of amortization. And I say a bit of amortization, you have to do a lot of amortization. So this is the one time, and if you're doing this on your exam, this is more complex than your exam. So if you're just watching this to study for your exam, you don't need to know this stuff for your exam. It will not get this complex because you have to amortize out multiple months, multiple years even. Which, if you know how many steps it takes to go through and just amortize the single month, that's a lot of calculations you have to repeat over and over and over again. And like I said, this is an okay calculator to definitely use in the real world, and these calculators are great tools, so I'm not saying don't ever use them, just don't be too reliant on them, especially for the simple calculations like what we just did here. Because, I mean, sometimes you got to trust these calculators as well to see if, hey, whether or not this is correct. So I've got a basic amortization calculator here. So again, these 6 points are equal to 0.75% of interest. And now what we want to find, we're going to take an amortization calculator. We're going to base it off of the $225,000 loan. But now, if you've used one of these amortization calculators before, you probably noticed there's a spot for the loan amount, there's a spot for the loan term, there's a spot for an interest rate, there's also a spot on here asking for my zip code. They're probably trying to sell me some loan product or anything like that, or somehow involve that in there. That you don't really need a zip code for the actual calculation with this. But now we're not going to put in the interest rate. What we're going to put in is just this 0.75. We're going to put 0.75% as our interest rate, because really we just want to find out what the difference is going to be. How much interest is this going to equate to on this side, this extra 0.75%, because that's really our difference between the two here. By prepaying this money, when is it going to work out to where we break even on this? So we're going to go to the amortization schedule on these, and the amortization schedule is the one where it has all the monthly breakdown of every single month, how much goes towards interest, how much goes towards principal, and then usually what your balance is being decreased by over time. So looking at the amortization schedule, by prepaying this $13,500, year one, 0.75% of interest ends up being $1,391. So we've got 1,391. Let me write that a little bit clearer so you guys are able to read that. So we have year one, $1,391. Now look, we could do some quick math here without even having to go down, because every year with this interest number is going to change as we go through this year for how much interest is actually paid over time. But looking at this, if this is $1,391 that we're having to pay just for this first year, we got to live in this property a lot longer than 1 year to make up this $13,500. It might make just more sense to do the 4.5%. So let's break this down in a different way here. So we know it's $13,500 is the cost of our points. So $13,500 is the cost of our points. And what I'm going to do now is I'm going to pull up two of these amortization calculators. And what we're going to do is you're going to actually go through and we're going to put one for 3.75 and one for 4.5 to see what that difference is in the interest. So we'll do one here, $225,000, 3.75%. And there's going to be other factors in this you have to pay attention to. So this is a little bit of an oversimplification with it here, but this will kind of help you understand this concept of the time value of money, because most of the time these discount points don't make sense unless you're planning on living in the property for forever. But now, how long is it until it makes sense? So looking at this amortization calculator here, what we've got is for our, which one is this? 3.75%. So with our 3.75%, we end up with $6,983 versus on 4.5% for just the interest, because that's all we're paying attention to here, $8,387. And now, look, we could already see that it's not that big of a difference in the amount of interest that we're paying over the entire course of a year. This is year one we're looking at here. So in year one, we have $6,983 versus $8,387 for the entire year's worth of interest. And now this could vary based on the amount of the payments and everything like that, and they're using standard amounts, but when you do have an actual quote from the lender, that's where you maybe dive into this a little bit further. So just the difference between these two, $83.87 minus $69.83, we end up with $1,400. So you can see how this isn't a perfect system. So this is really a difference here of $1,404. But even then, and now yes, the interest rates will decrease over time. It's going to take us like 10 years to make sense of this $13,500. Because that's only a difference of $1,404. Now, this is an extreme example because we're dealing with 6 discount points here. Typically, you wouldn't be dealing with that many discount points. In most cases, it could exist. You could have 20 discount points. There's nothing saying you can't. But if we have 1 or 2 discount points, it might make a little bit more sense. But when you start getting into these higher numbers, 6 doesn't seem like it's that much higher, but really you're only saving yourself $1,400 for that first year. If we look at year 2 here, year 2 under this amortization, they would just be doing some weird amortization with this, it looks like, because we end up with, okay, yeah, it's only factoring in just 2017, so it's leaving out January. So for 2018, and that's why we're going to have a little bit higher number here, 2018, we're looking at $9,912 on this side. So $9,912 for loan option B with 4.5% interest. And over on loan option A, we're looking at $8,236. So we've got $8,236 or $9,912. And this number should always be going down with the interest, but the calculator I'm using right now, and this is, again, pay attention to the tools that we were using. If we had more time, I'd go pull up one that just breaks it down for the years. But this is saying it's not necessarily year one. This is 2017. So this is a real-world calculator where it's going off of, hey, how many payments we have left during this year. So in 2017, we've got $1,404 that we're saving by doing all those, that $13,500 worth of discount points. For 2018, how much money are we saving? Well, all we're going to do is our 9,912 minus 8236, and we end up now we're saving $1,676. You can see this is going to take a long time to make up that $13,500. So the way this works with your client, if you could even just get this far and say, hey, look, this is only going to save you $1,400 this year, and that number is going to only end up going down when we factor in a full year here. That's the only reason why this savings amount went up. This is the maximum savings we're going to have here because it's basing in a full year, but our interest is going to continue to decrease. So between the two of these, we've got roughly about $3,000 that we've saved by having loan option A. But now what's the cost of that $3,000 savings? It's $13,500 it cost us to save about $3,000 up through December 2018 if we were to take out that loan today. So no, that many discount points, that high of a dollar amount of discount points doesn't necessarily make sense. And usually once you start to get above 2 discount points, that's where you really got to check these math and check these numbers and ask the question of your client of, hey, how long do you think you're going to be living here? Let's just do this really quick here. I'll try to pull out these numbers as fast as I can here, so try to stick with me. So we have 2018, because what I'm going to go off of is 5 years, which is on average how long somebody lives in a property for. So we have 1 year, 2 year, 2018, 2019, 3 years, 2020, and then 2021. So that's our 5 years all the way out through 2021. And with our 3.75% interest, 2019 is going to be $8,073. 2020 is going to be $7,904. And 2021 is going to be $7,728. So like I said, when we do have a full year, this number is always going to decrease. But this number is going to decrease over here on the 4.5% side as well. So for 2019, we're down to $97.39. On 2020, we're at $95.58. And in 2021, we're down to $93.69. And that's just our interest payment. That's the key thing. We're just looking at the interest payments for the entire year with these. We're not dealing with the total payment. So this is just the money that we're paying for the use of this money. So real quick now, let's go ahead and we're going to actually skip through these because we can just add all 3 of these together and then subtract one for another, and then we'll just add that to about our $3,000 that we have there. So we're going to do $97.39 plus $95.58 plus $93.69. And while we're at it, let's just add these 2 in here as well. So we're going to add the $83.87 and the $99.12. So during the course, up until 2021, with this amortization, you're going to spend $46,965 in interest at 4.5%. So at 4.5%, it's $46,965 in interest. For loan option A at 3.75% with the upfront charge of $13,500, we might be able to make sense of it here, but I don't know. We're going to have to keep adding these up and see. So what we're going to do, we're going to add these again as well to our $8,073 and all the years out. So we're going to have $69.83 plus $82.36 plus $80.73 plus $79.04 plus 70, what is that, 7? Yep, $77.28. And we end up down at $38,924. So 38,924 versus 46,965. You could see what the difference of that 0.75%, 0.75% of interest really kind of makes. Because we're only paying now in the interest payments $38,924 versus $46,965. But is it $13,500 worth of a difference? Let's find out. We're close, but I think we're going to have to go one more year to end up breaking even on all this. So 46,965 minus 38,924. Oh no, we're still a ways away. So even if we paid all this interest all the way out through 2021, so 2017, 2018, 2019, 2020, and 2021, we're just short of 5 years because we're leaving out January through about March. I don't think they're counting March. Yeah, they are counting March. So we're just leaving out 2 months here. So 4 years and 10 months, this is what it looks like. On 4.5% interest, you're going to be paying $46,965 just in interest. At 3.75% interest, you're going to be paying $38,924 in interest. Yes, that's lower, but it's only $8,041 lower. So we still haven't broke even yet. It's gonna take us a few more years. We'll probably have to go out to year 7, year 8, probably maybe even year 9. We'll probably have to live in this property 10 years before we start saving money because of this $13,500 we put up front, where we finally break even, because you're prepaying this interest across the entire 30 years. And actually, when this all works out in the end, it's all going to be the same. So this is eventually only, no matter how far we go out, we're only eventually going to get to the $13,500 when we get to the end of this term. But these are the calculations and the math that you need to do here, because paying these upfront discount points, you got to live there a long time, even 5 years out, and the average homeowner buys and sells every 5 to 7 years. So at 5 years, if they're paying $13,500 in discount points, they've only got $8,041 in savings. They're not getting a refund on the discount points when they go and sell the property. This is even worse if they go sell the property here. The only time you really want to do discount points is if this is a long-term strategy and we're looking at past 5 years, because it's going to take some time to basically earn back the savings that we're getting in these discount points. So the discount points, whenever you see them as part of a loan, any sort of, whether it's a mortgage loan or any sort of financing that you see, this is the calculations that you want to do. Maybe not even this in depth. You just want to know that, hey, when there's discount points, I've got to be in this in the long run. Which pretty much any other type of financing, except for maybe a car loan or something like that, another thing that you might be able to go out and sell, it's not going to make sense if you plan on selling this asset off. If you sell off this property, if you sell off this house at year 2, you've only saved about $3,000 at the cost of $13,500 to get that lower interest rate. So yes, the interest rate is lower. It should always be lower when you're paying discount points, but is it worth it? That's what the numbers are here to tell you. So this is an invaluable tool for you to use to help your clients greater understand discount points or any sort of the financing charges. The loan origination fee, that's a little bit more straightforward. That doesn't necessarily have an impact on the interest rate, but I've had a lot of clients that have worked with home builders, and they've worked with home builders and they've ended up having to, they were able to get a reimbursement for discount points due to their credit. So it might be good there, but if you're paying money for these, if you're paying money for this out of pocket, it's probably not worth it. And maybe if you're getting a credit from a builder, if you've got a $13,000, $500 credit, rather than going to the discount points, I don't know, maybe get some upgrades. Maybe splurge a little bit on the property. You've got to look at that from a different standpoint. But that's everything I got for you guys today on discount points. Hopefully you got something out of this show, something that's going to help you with the exam, not necessarily this stuff, because this is a little bit more advanced. Even in a broker exam, they won't make you do this much calculations because they just let you use that basic calculator. But this is how much more complicated it gets in the real world. So this is something where in the real world, it's much more complicated. And yes, there's all kinds of calculators and tools, but you want to make sure that it's an accurate tool. And number one, that you're using it correct, because you still got the opportunity for user error. If you understand it here, then you can start to use these tools to kind of make sense out of all this stuff here. But that's all we got for today. Make sure you turn in next week, 12 p.m. on Wednesday for next week's episode of Ask the Instructor. We'll be going over more technical real estate stuff like this here that's going to help you pass your exam, that's going to help you better serve your clients and help you seem more like a knowledgeable professional. And don't forget, on Fridays, we have State of Real Estate. And State of Real Estate, that's more about the business growth side of things. This is more part of your serving your clients. You kind of have to know this to serve your clients. But you don't need to know this necessarily to grow the business. That's an entirely different skill set and a different type of thinking. And that's what we do, State of Real Estate's 12 noon every Friday. We go through and we mastermind on ways to grow your business. We're not talking about stuff like this on Fridays because the focus of that show is growing your business. How can you grow and scale your business? What are ways to generate leads? What are ways to kind of scale your team, and so on and so forth. So make sure you check that out Friday at 12 noon. And if not, I'll see you back here, same time, same place, next Wednesday at 12 noon. I'm John Chrismo. The show is brought to you by the Tampa School of Real Estate, and thank you guys for tuning in today.